Hey everyone, and welcome back to the channel. Today, we're diving into a topic that separates the consistently profitable traders from those who are just spinning their wheels. It's not about finding some secret, magical indicator or a can't-a-lose setup. It's something far more crucial, yet often overlooked, the art and science of regularly reviewing and adjusting your trading strategy. Think about it. In what other high-performance field do professionals just set a plan and never look at it again? A pilot constantly checks their instruments and adjusts for weather. A coach analyzes game footage to tweak their team's plays. Trading is no different. The market is a living, breathing entity. It shifts, it evolves, and what worked brilliantly last quarter might be a complete dud today. If you're not adapting, you're essentially flying blind. So, why do the many traders resist this process? Honestly, it can be intimidating. It forces us to confront our mistakes, to admit that our perfect strategy might have flaws. It's a direct hit to the ego. But here's the truth. Your ego is the most expensive thing you can bring into the market. Profitable trading isn't about being right all the time. It's about being effective over the long run. And effectiveness requires honest, data-driven self-assessment. Let's break down how to build this review process into a routine, making it a powerful habit rather than a dreaded chore. The first step is diligent record keeping. I'm not just talking about your broker's statement. You need a detailed trading journal. For every single trade, you should be logging the date, the asset, the entry price, the exit price, your initial stop loss, and your take profit target. But here's the most important part. You must record why you took the trade. What was your setup? What confluence of factors gave you the green light? Was it a specific chart pattern, a news catalyst, a signal from your indicators? And just as importantly, log your emotional state. Were you feeling confident, fearful, greedy, or impatient? This data is pure gold. Okay. So you've been journaling for a while. Now what? It's time for the review. I recommend setting a dedicated time for this. It could be every Sunday evening, or at the end of each month. Don't just do it when you've had a bad week. Consistency is key. The goal is to be an objective scientist looking at the data. Start by calculating your core metrics. What's your win rate? What's your average risk-to-reward ratio? What's your profit factor? These numbers give you a high-level overview of your performance. A 70% win rate sounds amazing, but if your average loss is 3 times your average win, you're still losing money. These metrics tell the unfiltered story of your trading. Now, let's dig deeper. This is where the magic happens. Start sorting your trades. Filter them by the setup you used. Maybe you have a break-and retest strategy and a mean reversion strategy. Look at the performance of each one individually. You might discover that your break and retest trades have an 80% win rate, while your mean reversion plays are barely breaking even. That's a massive insight. It doesn't necessarily mean you should abandon the weaker strategy, but it tells you where to focus your attention. Let's go another layer down. Within your winning strategy, are there common themes? Do your best trades happen during a specific market session, like the London or New York Open? Do they perform better on certain currency pairs or stocks? Maybe you notice that your strategy works exceptionally well in a trending market, but gets chopped to pieces in a ranging environment. These are the patterns you're hunting for. Now for the painful, but necessary part, analyzing your losers. Don't just glance at them and feel bad. Scrutinize them. Categorize why they failed. Was it a bad entry? Did you chase the price? Did you ignore your stop loss? Was the setup technically valid, but the market just did something unexpected? Or, and be honest here, was it a completely impulsive, non-strategy trade driven by FOMO or a desire to make back a previous loss? I can almost guarantee that a huge percentage of losing trades for most developing traders fall into that last category, breaking their own rules. Your journal will expose this. If you find that 50% of your losses come from impulsive trades, then your problem isn't your strategy, it's your discipline. This tells you that your primary focus shouldn't be on tweaking your indicators, but on strengthening your trading psychology. Once you have this data, you can start making informed adjustments. Let's say you discovered your strategy underperforms in ranging markets. The adjustment isn't to throw the strategy away. The adjustment is to get better at identifying market conditions. You can add a new rule. I will not deploy this strategy if the ADX indicator is below 20, signaling a weak trend. Boom. You just use data to build a filter that should, theoretically, protect your capital and improve your overall results. Maybe your data shows you're consistently closing winning trades too early, missing out on bigger moves. Your risk to reward is suffering. The adjustment could be to implement a trailing stop loss, or to take partial profits at your first target and let the rest of the position run. You're not guessing here. You're making a calculated change based on a pattern you've identified in your own trading. This review and adjust cycle is a continuous loop. You make a small, data-backed tweak, then you trade with that new rule for a period. Then you review the new data. Did the change help? Did it hurt? Did it have no effect? This iterative process is how you slowly refine your edge, patching the leaks in your system and optimizing what already works. It is how you build a strategy that is robust and tailored perfectly to your personality and the markets you trade. Don't fall into the trap of constantly searching for a new holy grail strategy every time you have a few losing trades. More often than not, the path to profitability lies in refining and mastering the strategy you already have. It's about a commitment to continuous improvement. Treat your trading like a business, and this review process is your quarterly performance meeting with your most important employee, yourself. This process transforms you from a gambler hoping for a lucky streak into a strategic operator who makes decisions based on evidence. It builds confidence, not from a place of arrogance, but from a deep understanding of your own strengths and weaknesses. You start to know, not just hope, that you have a statistical edge over the long run. And that, my friends, is the foundation of a long and successful trading career. Thank you so much for tuning in today. I hope this gives you a practical framework to start improving your trading right away. If you found this helpful, do me a favor and hit that like button, and be sure to subscribe and ring the bell so you don't miss our next video. Drop a comment below and let me know what your biggest challenge is when it comes to reviewing your trades. I read them all. Until next time, trade safe and trade smart.